Hello, crypto bros, and we got some good news for you. We might finally see crypto on Apple. And that's because Apple got roundhouse kicked in the face by the DOJ. Now, I generally don't agree with the DOJ when it comes to a lot of things, but this time I agree with them, and it's good for crypto because Apple does engage in monopolistic practices. You cannot deny that. They basically built like their walled garden, and any way you find to get around that walled garden, bam, they shut it down. Bam, they shut any competitors down. And that's true for crypto as well. You know that you are not allowed to use any crypto in the Apple ecosystem because Apple likes that 30% they get if you use fiat payments. But if you use crypto, then Apple does not get that 30%. Like if you use crypto payments on stuff, it can't really go around that and get 30%. So Apple has shut off all crypto payments. Well, the United States government has ruled, hey, you can't do that because that is basically using your position, ecosystem position, and like app market position as a monopoly to basically suppress all competition. So they basically sued Apple for shape-shifting rules that throttled crypto apps and others. Now, this isn't mainly about crypto apps, but crypto apps are in the bunch. And so they're essentially ruling that Apple has to allow crypto payments. And obviously that's very good for crypto because that is a huge US ecosystem that crypto has been shut out of for a very, very long time. And of course, they made this rule because the Apple Store rules actually do enforce monopoly power. And I 100% agree that this is monopoly power use. Now, Google, I think Android saw this from a long way out. So they actually started allowing crypto payments in their apps as long as you disclose they were crypto payments. But Apple's like, no, no, no. We can't have any other payments because that gets around our 30% wall, and we want that 30%. So the US DOJ has slapped tech giant Apple with an extensive antitrust lawsuit claiming its app market rules and monopoly illegally throttled competition and suffocated innovation. I don't really know about the suffocating innovation part, but it definitely throttled competition because any other payment system could not get in. And since like app payment systems are absolutely key to many businesses, that throttled any real competition that could come in this space. This lawsuit is supported by 16 state attorney generals. The lawsuit has not been won, but it looks like it has a good chance to be won. Allege Apple has a monopoly in the smartphone market that it has used to force developers to use its payment system to lock in both developers and users on the platform. And that is entirely true because you do not have any option to use any other payment systems on the platform. They say Apple's App Store guidelines and developer agreements impose a series of shape-shifting rules and restrictions that allow the company to take higher fees, thwart innovation, offer a less secure or degraded user experience, and throttle competitive alternatives. Of course, that's Apple's entire goal because they want to choke off all competition. Quote, Apple's anti-competitive conduct not only limits competition in the smartphone market, but also reverberates through the industries that are affected by these restrictions, including financial services. Because a lot of people obviously like to do finance on their smartphone. Whether that's smart or not, I'll leave that up to you. But if you want to do finance on your smartphone, then you have no choice but to use Apple payment gateways. So they're basically leveraging their monopoly, or I guess like dominance in one market, to get dominance in other markets, and that's generally where this complaint comes from. And of course, it highlights the 30% Apple tax, which is what Apple is trying to protect, more or less. Apple often enforces App Store rules arbitrarily, and it frequently uses App Store rules and restrictions to penalize and restrict developers that take advantage of technologies that threaten to disrupt, disintermediate, compete with, or erode Apple's monopoly power. Absolutely true. Some NFT marketplaces such as OpenSea have disabled functionality on their iOS apps as NFT sales are subject to the 30% fee. So when you do anything online, it's subject to a 30% fee. I'm surprised when you trade on Coinbase, they don't slap you with a 30% fee. Not giving them any ideas or anything. But the 30% fee is pretty bad. That means NFT sales cannot actually operate on Apple unless Apple makes its own NFT store, and then it would be using its app position to dominate the NFT space. So that's an example of Apple's abuse of power. Obviously, this is going to affect Apple stock as it did go down because this really affects Apple's revenue all the way across the board. And if Apple doesn't win this lawsuit, they might actually lose like revenue that was pretty much for sure in their pocket. So very, very interesting in my opinion. And we'll have to see how this comes out. Traders that are trading Ethereum need to watch the $3,100 mark. Now, because the market's mostly recovered and we didn't really get too close to the 3,100 mark, I think it's okay. But there's a big liquidation mark at 3,100. There's roughly 212 million worth of leverage long positions that could be annihilated if we hit 3,100 or lower. So if we hit 3,100, Ether could be going below 3,000 almost immediately. Now, we did drop to the mid 3,200s a couple of days ago, so that was pretty close, but we did not reach 3,100. If we have another downturn, as in Grayscale starts selling a crap ton of crypto again, we need to watch the 3,100 mark, because if we reach the 3,100 mark for Ethereum, that could be bad days. Wouldn't really try to short around that area because it could obviously go either way, but there are a ton of leverage longs worth 212 million at that point. And if they get all wiped out, Ether could be seeing several hundred points of drop all at once it liquidates at about $3,100. We've already liquidated a lot, but there's a huge chunk there to liquidate, so we definitely need to be careful of that. And I want to talk about, ETFs have completely changed the game right now in terms of crypto markets and predictions, and have more or less obsoleted TA, at least temporarily. Now, why have I said it's obsoleted TA? I've mentioned this several times in chat or in my live stream, because TA really only works when there's a lot of people watch the TA and act as the TA tells them to act. TA, it basically works on a self-fulfilling prophecy type of thing. A lot of people watch like popular TAs, they all show the same graph. People will think that's how it's supposed to act and act in that way. There's no real logic that it should act in that way, but because a lot of people like think it will act in that way, it ends up acting in that particular manner. I don't know if I would say that's necessarily bad, but it's more like because what the TAers said and that they all kind of like agree. So like people just think the market's going to act in that way, so they act in a way that makes that come true, not because of any like mathematical or universal right thing that actually makes it in that way. However, the ETFs have completely changed the game because people that buy ETFs don't really care about TA. And that's why none of the Fibonacci levels really held in the 50,000s or 60,000s, because no one cared at all about what the charts said. They just bought ETFs. Right now, the price swings of Bitcoin are almost entirely dependent on inflows and outflows of ETFs. The last 3 days, last couple of days or last week have not been great because Grayscale started massively selling at pretty much the exact time we started going down. And we've had several days of consecutive sells. Thankfully, BlackRock and Fidelity have eaten up a lot of that. But remember, we're still down from about 73K to about 65K, 66K. And that is because we've had negative inflow-outflow numbers for quite a couple of days now. And it's mostly Grayscale. They've dumped over $1 billion of AUM. Now, I personally think that's probably the Genesis thing. And if that's so, they're really coming towards the end of that dump and we will go back up soon. But it could be something else. I don't know. Genesis just said they're going to sell over time. They're not going to sell all at once. They might have waited until now to sell when the price is sufficiently high, obviously. And BlackRock and Fidelity, like their buying was pretty big for 1 or 2 days, but they've actually gone back to like normal buying now. And like every once in a while, they'll spur up in buying, and that's when we really go up. So right now, like, the self-prophesizing TA charts aren't really working at all because you have a giant group of people who don't care about charts that are buying and selling in the market, obviously the ETF people. And as long as that's the case, I think TA is going to have very, very limited success in predicting like whether we're going to go up or go down. I think you're much better off just looking at the charts of actual sells and buys on the ETF and what the inflows and outflows are, especially over chunks of time like a week or 2 weeks, to get like a really good sense of how the market's going. Eventually, inflows are going to be greater than outflows in the long run, and that's why we're going up. But right now, it is completely the ETF inflow-outflow action that's dominating the market, not TA, not fundamental analysis, or anything else. There's obviously the meme stuff, but even the meme stuff is very much influenced by Bitcoin, which is totally being dragged around by the ETF inflows and outflows. So that's the news for today. Let me know what you think. Like and subscribe, hit that bell notifications button. Thank you, and have a nice day.